Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast, where I look to distill the best practices and best ideas of the world's most successful investors, families, and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of successful families and their family offices. Today's podcast is titled Gold and Family Offices, a different way to own and store gold. It features Simon A. Mikhailovich of the Bullion Reserve. I'm going to give a little bit of context, a little more than I normally do to today, and I'm really excited. Simon is truly, if I had to pick a handful of people on the subject I'd like to have on, he would be it. Years ago, we spoke at one of my Martha's Vineyard programs. Now, he's more of a Nantucket guy himself, but it wasn't too much of a journey, I'm sure, on his boat to get to Martha's Vineyard. And I really enjoy his thinking, his background, where he came from, his understanding of risk and how things could go terribly wrong. And what he's built, I think, is truly amazing. Many of you know I've been very active in the world of wealth preservation from my perspective for families of great wealth. I think we're in very challenging and turbulent times. I'm sure you'll all agree. And there's a variety of global strategies. There is no one perfect answer. It's a complexity of many for the last couple of months that we've been discussing. But I would think physical ownership of gold and some of the advantages and arguably disadvantages, and we know what they are, but we'll bring them up anyway, are going to be a very integral part to today's podcast. At the end of the podcast, when I talk a little bit about Family Office Association, more than normal, I'll talk about how we benefit our member families with opportunities, including in gold, but many other things that perhaps many of you are not as familiar with. On that note, to set the stage, I have deep thoughts about this, which relates to the Fed, monetary policy, hyperinflation, so many different things. When I looked at Simon, our special guest website, and you definitely have to check that out, he says it more eloquently than me. So if you don't mind, in setting the stage for today, I'm going to do a little bit of a reading of it. He starts with a quote from Ray Dalio. Many of you know, in Angelo's opinion, that's always a good thing. The current set of circumstances is unsustainable and certainly can no longer be pushed as it has been pushed since 2008. That is why I believe the world is approaching a big paradigm shift. That's Ray Dalio in November of 2019, before COVID, before the trillions of dollars of additional debt that we now have. You can imagine that only is exponentially, and many of us have heard or read Ray and some of his teachings about this would agree. I continue, not Ray, my thoughts, but really Simon's amazing words. Debt is the gist of the problem. Excessive debt caused the last global financial crisis, while multi-trillion-dollar bailouts averted a systemic. The debt problem has never been addressed. In fact, the global median debt to GDP ratio, a measure of systemic leverage, is now higher than ever, except for right after World War II, the most destructive global conflict in history. With debt levels and asset prices at their all-time highs and rates at their all-time lows, if not negative, the global financial system has never been more vulnerable. Add anemic economic performance, growing inequality, aging population, reemergence of the extreme right and left of the populism, deepening divisiveness, rising geopolitical tensions, etc., one would expect investors to be focused on capital preservation rather than on chasing returns at any cost. But this is not the case. Prevailing complacency is due to the lack of firsthand experience. While today's confluence of problems has happened many times before, it has not happened to Western investors in their lifetime. So they consider the outcomes that have typically followed periods of excessive debt, inequality, and political divisiveness to be impossible. Simon, those are really powerful words. I completely agree, but you're the one who wrote them. And that might have been even a year to a year and a half ago. How do you feel about this now?
I mean, even stronger. And by the way, the very important thing here is that the quote that you used from Ray Dalio in October of 2019 it didn't come out of nowhere. The financial crisis, this current financial crisis, has actually started in 2019 and had nothing to do with COVID. It was well underway by the time COVID hit, and it was simply exacerbated. And if you want to understand what I'm talking about, please check the news from September, the end of September of 2019, about the Fed, about the rates in the obscure and not very well known repo market, jumping to 10%, and the Fed announcing massive liquidity injections that I think they started with 15 billion, and then it was 30 billion, and then it was 50 billion, and it was for 2 weeks and 3 weeks. It's still ongoing, and the QE4. So all of that started way before, well, not way before, but months before COVID, and had nothing to do with it. And that's what prompted him saying what he said, which sounds prescient, completely prescient now, but it has nothing to do with COVID. I mean, COVID is like a heart attack on a cancer patient. I mean, it just pre-existing conditions. It's a crisis on a patient with pre-existing conditions.
I mean, we're probably not going to go into a full history of money and the value of gold from that perspective, going back really thousands of years ago. But I do think it's important to set a foundation before we get into gold specifically from an investing, a hedge, or more of a store of value. So I do think that sets an important precedent. So there used to be a time when the currency of countries was often backed by gold. If my memory serves me correct, only one country, and then it's only 50 cents on the dollar, that would be Lebanon, really has their quote unquote, their currency backed by gold. So I think most of my audience knows, but again, especially in a podcast, I never know who's listening. And we have much more to come on the history of money, fiscal policy, even cryptocurrencies and how this plays in upcoming future podcasts. But understand that the money issued by a country, the US, the dollar, is completely backed really by the full faith and credit of the government. There is nothing backing it. Now, I'll take a little bit of a step back. Technically, the US is a major owner of gold, although theoretically it doesn't back our currency per se. The US government does own significant amounts of gold. So I will admit that. But the fact that effectively every country is built on the full faith and credit, well, what if I was in Venezuela a couple of years ago? What if I was in Germany 100 years ago? What if I was in some of the other countries that have had deep and grave challenges? We assume this is not going to happen in the US, and I hope not. But we did see some civil unrest, Simon, like we never saw before, and we have a rising deficit. There are risks out there that I think we tend to gravely underestimate.
Well, I mean, there are risks and then there are certainties. So it's a mathematical certainty that the path we're on cannot continue indefinitely. It's a mathematical certainty. It's not my invention. I mean, maybe it's a certainty that's not relevant to our lifetimes because it continues beyond our lifetimes, or the crash happens afterwards. But in mathematics, exponential functions cannot go forever. So we have, for the past 40 years, essentially, if you look at the GDP versus debt, to the extent that debt keeps exceeding GDP, and to the extent we keep using debt to generate economic growth, that game, by definition, cannot be endless, because eventually, in theory, all the money that you have, all the revenues that you have, goes to pay the interest. Now, they've dispensed with that by having zero interest. But how long are you going to have investors invest money? Or like today I tweeted, Greece now has negative interest rates and 3-year. So Greece essentially charges for people parking money in its bonds. It's rated Baa3, which is a junk rating 3 notches below investment grade. And 8 years ago, the yield on that debt was 35%. So I mean, the question is Greece such a wonderful credit that there's a negative interest rate on that, or is it just some technical situation like we have now, and everybody thinks it's not really Greece's debt? ECB will print whatever money necessary to pay off whoever's debts need to be paid off. So that's not based on any fundamental idea. It's just based on flows. They think that there's no limit to flows and there will never be defaults. And so that's the basis on which that kind of investment can be made. And if anybody studies history, monetary history and just history in general, these situations have happened many, many, many times. They've happened in Sumerian civilization. They've happened to the Romans and the Athenians and the Egyptians. All of this has happened it's happened in the Middle Ages, in Europe. It's happened in our lifetimes, but it's just not in the West. It always ends the same way. It always ends with monetary debasement or bust or something where the system gets redenominated and reset. People who have money lose it. New people come and make money out of this debacle, and life goes on. So there's nothing unusual here. And so when you say, there's no certainty about what's going to happen and how it's going to happen and when it's going to happen, there's absolute certainty that this status quo cannot continue mathematically forever on a trajectory that it is on. I mean, just not possible.
I almost don't know where to start. So the challenge is a combination of discipline and really fiscal irresponsibility. The whole system of politicians here in the US every 4 years, all they care about is getting reelected, is looking good at the moment. They're willing to mortgage the future. And the fact that they could print money, unlike something like Bitcoin that we'll get to later, where there's a finite supply, or gold, where effectively to a degree, there's a limited supply. Money, they could print it like there's no tomorrow. So you have a saying, the world has a balance sheet problem, and it cannot be solved with aligning assets with liabilities.
Well, that's all it is. That's as we talked about before we went on. There are three ways to deal with debt. You can pay it off. You can default and renegotiate the debt, restructure, or you inflate, or if you're a government, you can inflate it. Inflate meaning devalue the money to the point where nominal debts are no longer burdensome. And that's exactly what most of the civilizations prior to us have done. I mean, there are things like debt jubilees. There are all different ways of doing it. But essentially, that's what it is. It's a reset. It's a financial reset where the problem, of course, is for both lenders and borrowers because, well, it's mostly for lenders because every dollar of debt is somebody's asset. So to the extent that the debts are reduced or wiped out or redenominated or whatever happens to them, the same happens to the assets. And to the extent that in real terms, these debts cannot be repaid, it means that the assets that are on people's balance sheets today, which own this debt as an asset, are not worth in real terms what they think it's worth. Now, it's worth today what it's worth if you sell it today. But if you hold it, its purchasing power, it may be the same amount of dollars or whatever currency, but its purchasing power will not be the same as before, because at the end of all this, there's an unlimited ability to create claims and currency, but there's not an unlimited amount of real profits and goods and services in any economy or in the world, or assets. And I do want to say, Angelo, that while you said that gold is not limited in supply, gold is strictly limited in supply. There's every piece of gold or every ounce of gold ever mined, except for a very small amount that's been lost in the, buried in the backyards or lost in the galleons on the bottom of the sea. All of it is still around and used and owned by somebody. And the only addition to that supply comes from the mining, which we know exactly how much it is. It's not a lot, maybe 1.5% of the outstanding stock of gold every year. And it cannot be increased by any sizable amount because it takes about 10 years to get a mine going from the start. So we know pretty much what the supply is for the next, at least 10 years. And we know how much of it exists. So yeah, it's very limited.
You brought it up before, and I think it is still part of the foundational aspect of the conversation and relates to what I said about politicians wanting their legacy to look good and could care less about the future. And that is basically banks. Look at 2008, the vast majority of them that had problems, and Goldman Sachs, like the most iconic investment bank in the world, needed government money, and Warren Buffett on top of that. So if banks can't fail, and we're seeing probably even some of that potentially happening now, if they can't fail, if the government's going to bail out airlines, they're going to bail out banks, then there's no reason for the management teams of those organizations to be fiscally responsible. This creates a really bad cycle.
Well, that's what socialism is all about. I mean, it's socializing losses, privatizing gains. Uh, it doesn't work. It's never worked. It's not my word. Please go read history. It works in theory, and as Yogi Berra said, the problem with that is that in theory there's no difference between theory and practice, but in practice there is. And so periods of acute inequality, monetary debasement, always get resolved, and either they get resolved financially or sometimes they get resolved politically before being resolved financially. In other words, Russian Revolution happened because of war and economic collapse and hyperinflation, and Hitler came to power because of war followed by economic collapse and hyperinflation. In other words, social forces have reset the stage if financial authorities are not willing or capable of doing it. And that's happened time and time and time again. And I'm not prophesying doom because we're still here, even though it's all happened. And I grew up in the Soviet Union. It happened there after I left. But I mean, Russia is still there. St. Petersburg and Moscow and the country, and it's all there. It's just the money's gone. And there are new people with money. Now they're oligarchs. There used to be party officials. So the game resets and new people show up. And in our personal terms, that's a tragedy. But in historic terms, countries and people survive, reorganize, and move on. But I don't want to be moved on, over my dead body, if you will, financially. So that's why I'm doing what I'm doing. So it's not out of some sort of a mystical or doomsday thinking. It's just very practical. It's like, how do I get from this side of this divide to the other side? I mean, it's happened again. I mean, it happens over and over again. That's why Ray Dalio says what he says. There's absolutely no mystery here. It just hasn't happened here since the Great Depression, but it doesn't mean that it won't.
You did mention it, and I was going to bring it up, and I think it is partially important to a little bit of the story. You're an intellectual coming from a different part of the world that was gravely challenged. I think of Nassim Taleb and his great work on Black Swan, partially from his perspective. You came from the Soviet Union, someone who's highly intellectual, who became a hedge fund manager, understands monetary policy and finance. How does that shape your view of things from a monetary perspective, and now your interest for many years now in gold?
Well, the question always in these type of situations is trying to understand the problem and separate the symptoms from the problem. So when we talk about these debts being so large, you have to ask why. Why have we run up these debts? We haven't run up these levels of debts before, so why have we run up these debts now? What happened in the past 30, 40 years? Has anything happened in the last 30, 40 years? Why are these problems there? Why is this wealth inequality? Why? And I think what's important is to go to the source of this problem. It's like, heart attack is an acute symptom that, of course, can kill somebody, but one doesn't get heart attack unless one has heart disease, which is arterial blockage. So if there's no blockage, there would be no symptom that could kill you. So debt is a symptom that can kill you, but the underlying problem is that the United States has had an issue with its economic model for the past 40 years. I mean, in 1971, when Nixon went off the gold standard, we were forced off the gold standard because our obligations exceeded our ability to pay in real currency. And since then, we've been meeting our obligations with unredeemable, fiat currency, which people have accepted on faith. It's a faith-based initiative. But why have we needed to do this in the first place? And I think in thinking about it and thinking it all through, I came to the conclusion that something has happened with the economic capitalist model. And that's a separate conversation for, a pretty expensive conversation as to why that is the case. But something happened whereby the normal economic cycle of investment, savings, investment, value added, and growth propelled by population growth and market expansion has stopped. And essentially what we've been doing for the past 40 years is we've been subsidizing with debt growth, both in production and consumption. We all know about consumer debt. We all know about borrowing money to buy things. But why is this really happening? And so if you look at the standard of living of the US, which by the way is ahead of everybody else, but on a relative basis, the median wage hasn't increased since 1968 really in any meaningful way, which means that whatever growth listeners, personal and financial listeners on this call may have experienced, has not been experienced by a very significant portion of the population. There are fundamental reasons for that. And so the solution for that has been the creation of debt and this printing of money and the bailouts. Because when you're in a leveraged situation, you can't let anybody fail because everybody takes everybody down. That's the problem with derivatives in general, which on the net basis, there's zero exposure. But that's only if everybody can meet everybody's obligations. And that's what we saw in 2008 when AIG could not meet its obligation. The entire financial system collapsed, requiring an overnight $200 billion, quaint numbers by today's measures, of capital injection to bail out the financial system through AIG. Because losses from subprime mortgages, which was not what this crisis was about, actually, it was the precipitant for that crisis, wiped out bank capital. That's what leverage does. I mean, you don't have to lose all the money. You just have to have enough to have no capital left, and then that's it. And that's what leverage does. So this is a very complicated situation. I maybe sounded a little disjointed here because when you start discussing it, you don't know where to start. But the issue, I think, to me, is that there is a fundamental problem. We have a fundamental problem. It is unresolved. It's a complex problem. It's a multidisciplinary problem. It has to do with politics, with geopolitics, with exporting production to China, with essentially globalization, which required the US, we've created tremendous wealth for China, but we've had to subsidize our own consumers. This has been done with debt. We've subsidized our own companies with debt. And now everything is levered to the hilt. And the rates are lowest in 5,000 years. And the asset values are highest in 5,000 years, just because present value of future cash flows increases when rates decrease. And when rates are at their lowest, present value is at its highest. I mean, it's just the way financial math works. There's no mystery there. And there's no way to increase the rates because there's no way to service the debts at normal rates. So we're in a corner. And the question is, how long can we continue to exist in this corner? As we're seeing, political fallout from this has started several years ago and continues. And so the divisiveness, the disagreements, this is all very bad. I mean, this is all essentially ability to preserve wealth in large part relies on legal and sovereign stability of currency, stability of property rights. And I see tremendous instability in addition to financial instability. So to me, it's pretty obvious, but it's also another lesson of history is that most people don't see it coming. Why did certain, German Jews didn't leave Germany? Well, some did, but most didn't. Why didn't most people left the Soviet Union when we did? Very few did. It was in the 70s, 1970s. It was way before the collapse. Bulk of the immigration occurred after the collapse. Well, by that time, there was nothing to lose and it was all clear. When we were leaving, there was something to lose. There was huge opportunity cost, potentially, or people thought anyway. So it's not that different. I keep harping on this theme, but it's true. And I think some of the things we're talking about are very radical for many people to buy into, I guess, or to appreciate.
Yeah,
real.
Some people probably expected me in my first or second question, just get right to gold. And trust me, we definitely have a lot of gold questions. This is the foundation. This is the why for gold. And if you don't have at least a basic understanding of it, then this is just any other 30 to 45 minute conversation about gold. I don't want to do that. I want a deep intellectual dive, which is the value, hopefully, that we provide. And certainly in Simon, the right person to have on that. Every dollar of debt is someone else's asset, I guess you could say. Do people really understand that? It's a debt, who's on the other side of that?
Pension funds, the wealthy, holders of savings. That's who's on the other side of that. That's who's going to get hosed in this. The holders of wealth.
I've been talking about that for a while, but people think I'm a crazy libertarian when I start to talk about that.
Well,
actually,
yeah, go ahead.
On that political front that I think you set the stage for greatly, the reality is when you look at past governments, countries, civilizations that have kind of failed, and I'm saying this as a libertarian, I understand it, but the growing inequality is an issue. At the end of the day, when there's way too much have-nots versus haves, and their voting power each counts the same, that what's going to happen is what we started to see in the last couple of months and years, the rise of someone like AOC that probably 10 or 20 years ago would have had no chance. But now she touches the heart of many millennials in Generation Z. And, the irony with the election, and this is right after, about a week after the election now, so people are listening to this in 10 years, they have some context from 2020, where it appears to be Trump lost, but we don't know that yet for 100%. Now, you can make the argument, Simon, that perhaps Joe Biden winning is going to calm some of the challenges we're having with issues in cities and uprisings if it was counterbalanced by probably a Republican Senate, which is probably going to be the case. Although I may disagree with it per se, you can make the argument that maybe this is not necessarily a bad outcome. I'll slightly reposition it. This summer, one of my families, who's second generation from, let's just say a country that has had issues, basically told me, listen, the odds of chaos in this country pre-COVID and pre-civil unrest, he thought was like 0.0001. And now we put it at like 3 or 4%, which is still relatively nominal, but that's enough to get attention and dangerous. Things could get topsy-turvy, chaos. But would you maybe agree that a little bit of the balance in the political power, checks and balances, may play out a little bit to our favor, or is that just delaying the inevitable?
Sun Tzu, The Art of War. There's there are a lot of great.
It's legendary.
There, but one of them is great. A strategy without tactics is the longest path to victory. Tactics without strategy is the noise before defeat. We're talking about tactics here because one thing we didn't mention, okay, there are all these debts. Okay, that's one issue. There's also a 75 million just in the US baby boomer population who has been promised some very fabulous benefits for which the government has not reserved any money. So these are unfunded but mandated legally liabilities. How can there not be a major battle royale coming very shortly? Intergenerational warfare, because people who are supposed to pay this as you go, which is the only way it can be paid, are the millennials who don't have the money to pay and are not going to be willing to pay. They're the AOCs of this world. They're the ones who are saying the system doesn't work. It doesn't work for them because our generation is going to collect and their generation has to pay, and they can't. I mean, they can't. It's just not there. Look at the numbers. I mean, look at the CBO, Congressional Budget Office reports. Don't listen to me. It's all there. The facts are all there. These facts are not in dispute. What's in dispute is the implication of these facts. Some people just say somehow it's going to work out because in my lifetime it always has. And I say, what if it doesn't? Can you afford to be wrong? So when you said gold is, discussion of gold is very short if you understand which it's a solution to a problem. Gold is a solution to a problem. So if you don't understand the problem, you're not interested in the solution, and it's a waste of time to discuss it. It is only when people understand the problem it becomes clear what is the purpose of gold, what properties of gold fit the bill in this particular situation, and then how to own it to maximize the efficacy of those properties. That's really all it's about. So the first question is, what's the problem? If people disagree about the problem, there's no need to talk about solutions. I mean, it's just as simple as that.
I completely agree. That's why I felt it was important to set the stage. The approaching paradigm shift poses, I would say, two challenges, which perhaps brings us a little bit into a solution: how to protect capital and how to profit from a fallout.
Yes, those are the two. The best way to protect capital is to, well, you can't protect all the capital if we go through something of what we're talking about. So the question is, how can you create reserves so that one is not dispossessed under the worst case scenario? And how does one mobilize these reserves in the depths of the crisis to take advantage of the opportunities which eventually arise precisely because most people don't have access to reserves? I mean, that's why things trade at cents on the dollar, because nobody has any money to buy them. So that's really, I mean, from my point of view, that's the way traditionally capital has been preserved through crises, is one, by having liquidity resources that are independent from whatever debacle is going on. And second, how to redeploy that. So it's not like set it and forget it. There is nothing like that in this world. Everything is somehow an active strategy of some sort. And so, because there are no like solutions where you can just put it and not think about it until something happens. And so that's how I started thinking about it. And that's why I started doing this, because I just realized, and I found through personal experience, that owning gold physically is not that easy. And there are a lot of issues. And there are some regulatory issues which make it very difficult. And so that's really the reason. It was very natural. I mean, my background is I ran a hedge fund firm for 16 years, dealing in credit and derivatives, credit derivatives. So I understood that world very well. And that's what gave me an idea, by understanding how credit was being provisioned in this country, what happened to the migration from pre-financialization debt and post-financialization debt and derivatives. For those who want to know what I mean by financialization, it's a combination of derivatives and leverage. We have levels of leverage that we don't even know what kind of leverage it is. The numbers that we're looking at are just what's reported. The leverage embedded in hundreds of trillions of dollars of derivatives is completely imponderable. That has never happened before. That's a function of technology. It's like nuclear weapons versus conventional weapons. I mean, these are nuclear financial weapons. And so we don't know what their impact could be. But again, it's all part of what we're talking about here. How do I not become dispossessed? And how do I have the means of restoring whatever wealth has been lost through investments at a time when nobody has money to make any investments?
I mean, I don't mean to get a little off track, but what you just said reminded me of this. And in my upcoming conversations in the coming weeks about banks, the Fed, monetary policy, one of my questions basically is going to be, I'll ask you for your opinion. The reality is, I don't know if we really know, even looking through public companies that clean things up at the end of the quarter, at the end of the year. What are some of the risks that our banks are taking? What really is the true picture? We don't have a snapshot intraday exactly what goes on. And you mentioned derivatives, which couldn't get any more complex, even for probably 99.9% of the economists out there, or regulators. And banks are effectively intermediaries for the government, and that is changing a little bit with blockchain and some of the dynamics happen there. One, if you wanted to comment about that, and then related to that, an analogy that I believe you give, a backup generator must be independent of the power grid. The financial backup plans must be independent from the financial system. And banks, as far as I know, Simon, are a part of the financial system.
Well, part of the financialization, which is derivatives plus leverage, is also disintermediation or disconnect or agency problem, whatever you want to call it, between the management class and shareholder owner class. Because essentially, we have gone into a situation where people own securities. They don't really control any companies. Wealth used to be held when families actually owned companies. And so they ran those companies, or they had private management that ran it for them, and they were involved in the companies. They had firsthand access to information. Now we have this public company system where basically the management works for itself, and its compensation is based on shares, on the price of shares. And the objectives of a CEO are short-term in nature as opposed to long-term in nature. So there's a complete disconnect between the interests, if you will, of money managers and company managers and their clients, because they get compensated today for doing things that make money today, which may destroy money tomorrow. But tomorrow, I won't be here, you won't be here. In the meantime, I got a family to feed, I have kids in college, so this is what I'm doing. This is what's been going on across both the management classes in the industrial and corporate America, and the money management classes that manage other people's money. Because if you allocate to me today, then I'm going to put the money to work, whether it makes sense or not. So there's a lot of this is, again, like I said, it's a multidisciplinary approach. I'm sorry, it's a multidisciplinary problem that requires, or a multifaceted problem that requires a multidisciplinary approach. So we have a lot of overshooting in a lot of areas: leverage, demographics, politics, geopolitics, the status of reserve currency, US dollar as a reserve currency, the abuse by the United States of that status, the disconnect between the interests of different parties, self-interest of different parties that are no longer aligned as they may have been before, between the people who manage the money and people whose money it is, people who manage industrial assets and people who are the shareholders, who theoretically own these assets. And all of these misalignments create this sort of uncertainty that is never acute enough for people to do anything, for most people to do anything about it. That's really, I can tell you from personal experience that my phones were ringing off the hook in the middle of the COVID crisis. And as soon as the market got reflated, interest palpably waned. So most people don't believe there's a problem, which of course is always, that's the opportunity. The disconnect between perception and reality is where all investment opportunities are.
Well, let's go a little back and forth on something, Simon. Now, yes, I am a fan. You could probably tell in my tone and all that families should own physical gold. But looking at relatively recent history, even going back longer, as protection against inflation, that certain equity holdings have been significantly better. And now, being a tactical era, Apple, Amazon, Microsoft, there's some obvious, at least currently, winners that are likely going to get you a much better return. I had Peter Schiff on in March, and gold was going to go up multiple. It really didn't, partially because the economy was artificially propped up. I get it. But you're not saying, I know, put all your capital into physical gold. But in terms of protection against inflation, the equity markets, specifically now more tactically in some of the companies I noted, appear to be perhaps a more logical approach. Where is that wrong?
If inflation was good for stocks, how's Venezuela companies doing? I actually did. I'm not being flippant. I did. The people who studied finance know about the Ibbotson study from the 1970s, inflation of the 1970s. I did my business school thesis on inflation in stocks. There's no evidence that stocks provide any. Look at the 70s. Look at what happened in the 70s. It was a horrible bear market in stocks for 10 years. And in fact, if you take the 70s, let's just take the 70s, in nominal terms, from, let's say, Nixon took the dollar off the gold standard in, I think it was the summer of 71. So if you take the next decade, say January 1, just for easy count, January 72 to 82, stock market went up, I think 15% for 10 years. But the dollar lost 60% of its purchasing power. So people who stayed in stocks, in index funds, for example, I don't think there were index funds at the time, but let's say there were, there would have been, or there will be now, lost half their money. Not nominally, in real terms, half the money. Gold went up 10 times or 8 times. This is not counting the visit to 800. This is starting at 35 and ending up in 350. without accounting for the spike.
True, but
So-
you're being a little bit more broad, Simon. Could I argue that concentrating being tactically Apple and some other stocks, they appear to be tremendous winners this year. Nothing lasts forever, but should families be able to ride that out to counterbalance the effect of inflation, even if it's economically not accurate?
Successful speculation in anything, hyper successful speculation in anything, can be very profitable, but it entails risk, and it entails a risk of loss. So you can't compare. I mean, gold is a risk-free asset. I mean, it depends. The question is, what is risk? That's a very big question, which underlies all of this. Risk for the past, in the world of financialization, risk is defined as volatility. Volatility is fluctuation in market prices. That's what is defined as risk. But that's not how I define risk. I define risk as permanent impairment. It's not when the market value of what you own goes up and down. It's when the asset actually loses value permanently and will never be restored to its prior value. So in that sense, gold is a risk-free asset. It does not have the risk of impairment, which is why it's been used the way it's been used. I mean, a bar of gold is a bar of gold. This year, next year, 10,000 years from now, it's the same thing. You know, a company like Apple, I mean, there was a company, Commodore. I mean, Commodore Computer was the biggest selling computer in the world. I'm not saying Apple's going out of business, don't get me wrong. But, you know, companies get displaced. You know, new technologies emerge. Some companies, so yeah, just because it's a great bet this year, fine. That's not what gold is about. I mean, I'm not proposing gold for a trade. That's not what we're talking about. We're talking about a once-in-a-lifetime transition that I believe is going to happen very shortly in our lifetime, which one needs to financially survive. We're not talking about whether it's good to invest in Apple or, I don't know, Google this week versus that week, and I can make a lot of money doing that. Sure, but in 2000, all of those stocks went down 90%. I mean, it happened. So right? And many of those companies disappeared. It's easy for us to know now who survived, but you know, Apple has had a few brushes with posterity, you know?
Yeah, I mean, you're correct. Hindsight's 2020. We talk about governments being able to print money. Am I wrong? Companies could issue more stock. So
Companies
a little
can
bit
issue
similar
more
to
stock.
governments, they could fall to the same challenges.
Consider the other thing, you know, the government, US government is spending what, it's extra $1 trillion a year every year or something like that.
Mm-hmm.
I mean, that trillion, what are they spending it on? Goods and services, right? Transfer payments. Well, where's that all going? Well, all the companies you're talking about are selling goods and services that are paid for with this borrowed money. So what happens to the financial position of these companies, their balance sheets, if suddenly consumers can't borrow this money, or the government, because of a currency crisis or because of a loss of confidence, is not able to borrow $1 trillion and spend it that doesn't exist year in and year out? That's not a trivial sum of money, by the way. Especially when you consider it, you know, as revenues for companies. I mean, $1 trillion of revenues is a lot of money. All of this is going, defense contractors, government service providers, people who get food stamps and whatever. I mean, they spend money. I mean, there's $1 trillion being spent that doesn't exist. This is just from the government transfer payments. This is not counting all the other money that's being borrowed and spent. I mean, think of a world where suddenly growing debt by X% every year becomes impossible. There will, what? The pie gets what, 20% smaller? I'm not talking about 80%, 20%, 15%. So 15, 20%, lop it off of everything. What does it do on a levered basis if you're levered 6-to-1? How much capital do you lose? I'm not talking about investors having capital. I'm talking about companies who are levered to these sales with the debt that they've taken on. So I'm just saying, I think as Rumsfeld said, or who was a defense secretary under Bush, there are known unknowns and then there are unknown unknowns. And so we have a tremendous amount of known unknowns. And on top of that, we are dealing with unknown unknowns. And people behave like this is going to go on forever, just the way it's been going on. I mean, the stock market is an all-time high. Is the economy at an all-time high?
Far from it.
I mean, you know.
Only physical gold uniquely combines inverse correlation to confidence, complete independence from the financial counterparties, and global liquidity under all market conditions, you're quoted as saying. Uh, Transferring now into the answer to some of those questions, how to protect wealth and potentially how to profit from the fallout, you keep on emphasizing or have physical gold. Talk to us a little bit about the advantages during the times we have as a store value and how valuable that is to families of owning, and I'll emphasize it again, physical gold.
Well, the reason gold is a quote unquote insurance or hedge or whatever you want to call it, it's not a market value in real time concept. It's a bigger concept. It's more like insurance without an insurance contract, without a counterparty. The reason I say this is because to understand how this works and why it has to be physical gold and not other gold, you have to think of gold price formation. I mean, what makes gold prices go up or down? And ultimately, it's supply demand. Now, for the past number of years, derivatives have dominated gold price moves, and that's because confidence in the system has been high, and so people, the counterparty risk has been acceptable, and people are not interested in taking possession of the metal. As soon as confidence wavered and people who are in this business decided that they wanted to take possession of the metal, there were major disruptions on COMEX in the spring. There was major misalignments of prices between physical prices and futures prices, shortages and so forth. So the price formation, to think of gold price formation in a simple terms is this. It has been proven, and there's plenty of data, and it makes perfect sense, that desire to own gold is inversely correlated to confidence in financial assets, stocks, bonds, currency, is inversely correlated to people's confidence in property rights, in safety of their assets, and so forth. I mean, that's a given. I mean, like I said, we saw that. That's why my phone was ringing off the hook in March and April. So in that type of a situation, you have to intellectualize how much is out there in terms of financial assets. What percentage today Western investors own in terms of their quantity of financial assets in terms of gold? It's virtually nothing. I mean, it's 1% or something. What would make them change their mind? Is it like change their mind, meaning become less confident in the solvency and value of financial claims and the safety of the assets in terms of banking system and governments and expropriatory taxation and so forth? And then just look at supply and demand. I mean, you have a vast potential demand with a very limited potential supply. And furthermore, most of the gold is already owned. Only 1.5% is produced every year by the mines, and that gold is always available for sale. But the rest of it is not available for sale. I mean, it's available at the right price, but it's not automatically available for sale. Somebody already owns it. And so in that situation, you have to not only understand the potential demand, you also have to understand potential supply. So if supply mostly comes from people who already own it, then their level of confidence in financial arrangements, assets, governments, property rights, civil rights, make them maybe prefer to continue to hold it as opposed to exchange it for money. So that's the asymmetry that gold has. That's pretty unique, is because it has not unlimited, but it has vastly larger potential demand versus available or existing physical supply. And furthermore, under the circumstances when demand is the highest, the supply usually dies because people who already own gold are scared to sell it or don't want to sell it because they don't have confidence. And people who don't have it or want more of it are desperate to buy it. And because prices are set on the margin, it's the next marginal level of desperation of the person who wants to buy it and the level of discomfort of the person who has it to sell. So if you think through what I just quickly said now to its logical conclusion, you could realize that it has a lot of characteristics of a highly asymmetric option, except that this particular option, if you own it physically, has no counterparty risk or minimal counterparty risk, certainly not systemic counterparty risk. It's an option that doesn't expire, will never become worthless, has no impairment risk. I mean, if this were actually a wealth management product marketed by Goldman Sachs, there would be a line around the block 3 times to buy it. But when you explain this, and I say it's physical gold, people say, that again. That's kind of the reaction. So yeah, and why do you own it physically? Because the highest value for this asset comes, as I just explained, at the moment of least confidence and potentially of least safety for other assets. So just like buying insurance against subprime mortgages from AIG proved to be a winning proposition because of the bailouts by the government. But in the absence of the bailouts by the government, it would have been a losing proposition because they sold insurance, but they couldn't meet the claims. They couldn't pay the claims. So it's the same thing with the banking system. I mean, if the purpose of establishing reserves is to sequester or decorrelate a portion of holdings from the potential problems, and the value of these reserves would be the highest at the moment when the risks or potentially the real problems with financial system and financial arrangements would be the highest. And why would one want to tie one to the other? Because the probability of not getting paid increases in direct proportion to the value that you're holding in this reserve becoming greater and greater. And the ultimate result, if you hold it through financial instruments, is that at its highest value, you're guaranteed not to get paid, because the highest value of gold will happen if, God forbid, the financial system does collapse as it did in the 1930s. And so why would one want to have money essentially in the bank when a banking system is a problem, or in the stock market where potentially that is a problem? Now, furthermore, one has to realize that this is a very important situation from a geopolitical point of view, and geostrategic point of view. The United States' ability to meet its obligations with respect to defense, social obligations, to keep, the peace against disruptions and so forth, is very much connected to the status of the ability to borrow and to the status of the dollar as a reserve currency. And as John Bolton, not a very attractive person, but who said a couple of years ago, but he made a valid point. He said, when there's that much debt, it's a national security issue. So it is a national security issue. And because it is a national security issue, whatever ideas one might have about the fallout from a financial crisis have to be put through the prism of also a national security crisis. And in a national security crisis, government may take very different measures preemptively, such as closing stock exchanges, imposing capital controls, which would be perfectly rational actions, as pernicious as they might sound. But that's what happened in Cyprus. That's what happened in Greece. That's what happened in Yugoslavia, Russia. I mean, Venezuela, Argentina, every time they have a debacle, and God knows they have it every few years. So it's not like there's no playbook here. I mean, we know what the playbook is, and the playbook is pretty tough on the holders of capital. So if you talk to people from Argentina, wealthy people from Argentina, they have learned how to deal with this. But the relief valve that the world has had for the past 60, 70 years has been the US dollar, or Swiss franc, or euro. All a wealthy person needed to do, if their domestic currency or their domestic situation was in trouble, is to open an account in a Swiss bank or a US bank in Miami, if you're in Latin America, open a dollar account and you were fine. Well, what happens if the dollar is not fine? What happens if the dollar gets devalued, or there are capital controls, or there are these types of things that we haven't seen in our lifetime in this country, but our grandparents, or those who were here that saw? What if that happened again? Like, what's the backup to that? There is no, what is the other currency in a bank account, and where, and then what? And of course, it's already became almost impossible for Americans to open bank accounts abroad. I mean, it's already a problem. So that's where physical gold comes in. It's an asset that's not in the financial system, that doesn't fall into the regulatory framework of the financial system, that can be physically segregated and owned outside and in different countries. That's not easy to get to for the government or for anybody else. And it's this otherness of it that makes it compelling, or made it compelling to me. It's the utter decorrelation. And whatever we think in the Western world about gold, it's a more liquid market than S&P 500, or it's as liquid market as S&P 500, actually, globally. I've seen the numbers on that. It's global. There are 3 billion people in the world saving gold. They don't have any issues with, vexing as to whether it's worth something or not. And so it's like Picasso. I mean, you don't like Picasso, fine, don't buy it. I mean, there's a market for it, and it's worth 100 million a piece. But that's okay. You don't have to have it. That's kind of the way to approach it. It's not that I believe in it and others don't. I mean, there's a critical mass. There's a market, and the market has its supply demand already. And the question is whether today's supply demand is minuscule compared to demand, minuscule compared to potential demand. And I believe that it is. By the way, it's the same argument with Bitcoin. It's precisely the same argument.
Yes, and one
and for
from
the same
a
reason,
perspective that we'll be getting into shortly. And again, a reminder to everyone, when I say kicking things off a long form interview and wanting it to be that way, I meant it. Most are going to be about an hour. Today's probably going to be closer to an hour and a half. I really wanted to do a deep dive. And reminding that central banks and governments hold a portion of their reserves in physical gold, even though it may not be theoretically, quote unquote, backing up their currency, the fiat currency. This is something that banks around the world, including our own US government, have significant amounts of gold. You partially answered in your response, but there's probably 6 risks that you have to look out there: price risk, liquidity risk, model risk, counterparty risk, and geographic risk. And I think you strongly answered the latter two. Counterparty risk, unlike financial institutions or financial assets, physical gold does not depend on functioning financial institutions and markets. It's no one's liability. And geographic risk, you just noted, physical gold is the only tangible liquid financial asset that can be practically held in diverse jurisdictions without involving financial institutions. I think it should be obvious to our audience, but nonetheless, bring it up. Other than investment speculation, owning ETF and futures in gold has nothing to do with it as a store of value. Talking about being uncorrelated, they have nothing to do with each other. I think you already somewhat explained it with the financial institutions and derivatives. That being said, though, Simon, maybe give a 1 or 2 minute recap why what we're talking about here, it strictly is physical gold.
Well, I mean, it's like owning actual property and owning shares of companies that own properties but have other operational management and other issues. Just because there's some property underneath that may be worthwhile doesn't mean you're going to get to it if you own shares through an exchange. And what I mean specifically in the ETFs, I mean, I don't want to go into the details of how they're constructed, but people who are sophisticated to understand the difference between open-end funds and closed-end funds and the disconnect between share values and underlying asset values that happen in closed-end funds. These ETFs are hybrid vehicles where there's a very complex mechanism as to how too big to fail banks, who are so-called authorized participants, market makers, equalize the prices of gold ETF shares to the value of the underlying gold in the ETFs. This is an entirely market-dependent process, and to the extent they're unable to do it for whatever reason, the claim that you hold may or may not reflect the value of gold properly underneath. Furthermore, the claim that you hold is really in a custodial account in digital form at a broker-dealer that could be shut down or whatever. I'm not going to get into specific risks, but the bottom line is owning a stock that's digital asset held through street name by a broker-dealer, traded without any commissions, and think about why that is. Why do you not pay anything for trading commissions? There's no free lunch. I mean, you're paying it somehow, and that part of what you're paying is how you own it. And so I just don't think I think it's fine to speculate, use those vehicles for speculation, short-term speculation. There's no problem with them. I'm not saying they're fraudulent in any way or anything like that. It's just they're not robust if there's anything happens. It's no different from any other stock. If you need liquidity and the exchange is on a holiday, you're not getting liquidity. Well, there's a Russian saying about that. The spoon is dear at dinner time. I mean, you don't need a spoon unless you're eating. I mean, you only need it when you eat. So you don't care that you don't have a spoon most of the day, but when it's time to eat, you need a spoon. So that's when you're not going to have it. So that's why that's not the right way to go.
Yeah, I know. I love, you brought up a subject, don't get me started on, relative to street name of digital ownership of stocks. That's a very sensitive topic of mine. We'll do a deeper dive of that one in the future. And again, I hate to be someone who's always looking to hedge risk and build a deeper moat around the castle, but I think these are the things the risks that need to be made aware to families and their family offices so they can make an informed decision. And often it's to be an ostrich and ignore it. But these are things that could go wrong. Talking a little bit about what you've built, which is a very unique structure for effectively ownership of physical gold. So to benefit from gold's diversification properties, you must ensure independence from the financial counterparties and access to global liquidity. Your organization, TBR, was designed to accomplish exactly that. And I think it's very unique. If you could talk to our audience a little bit about what you built.
Look, I mean, there's no mystery here. It's a physical good. It's a financial asset, but it is not a financial asset widely invested in the United States or in the West. And so there's really what I found when I started investing in it myself, for myself, is that there's really no fiduciary infrastructure, if you will, for high net worth investors to invest in large quantities of gold. Because from a regulatory standpoint, physical gold has a lot of features of cash. So just like with cash, whereas 10,000 or 15,000 or 20,000 in cash and $20 bills is imminently liquid, $500,000 or $1 million or more in a suitcase in $100 bills is not only illiquid, but downright dangerous for a whole lot of reasons. And it's the same kind of thing. People think, oh, I'm going to go buy these bars, $1 million worth of bars. I'm going to put them somewhere. Well, okay, I'm going to take $1 million of cash and I'm going to put it somewhere and then I'm going to spend it. How? How are you going to spend it? To whom are you going to sell it? What are they going to think about you and where you got it and all that kind of stuff? So what I've discovered is that while there is a well-developed, pawn shop and coin shop business, there are platforms, there are online dealers for coins and retail high markups, not great service most of the time. And then there are financial products, ETFs, which basically created by what I call it asset management industrial complex to help people speculate. What I didn't find is some sort of service or business model that would address this physical item and its commercial supply chain, which is mostly commercial, which is refineries, gold miners, secure logistics companies like Brinks, that vault gold, move it around in armored cars. With fiduciary aspects that we're all used to, like accountability, transparency, audits, compliance with laws and regulations. And I just created one by using a private fund structure that's used by private funds, 10,000 of them, and applying it to a different discipline. So on the one hand, it's a fiduciary construct, legal construct, that has all the proper controls, administration, third-party administration, like what you're used to seeing in hedge funds and other types of funds like this, except that there's nothing other than physical inventory inside. And the other thing I realized is that to operate in this business fluidly, if you will, with options and around the world internationally, one has to be, just like in many industrial and commercial businesses, one has to be a member of the club, if you will. You have to be a recognized business. You can take any example. You can't, wholesale food distribution. If you're not a supermarket, you can't buy from Cisco. I mean, a retail customer cannot go and buy wholesale groceries, typically, particularly in size, unless you become that kind of business, and then you have to establish yourself and be in that business. And it's the same thing here for for investors, even for institutional investors who are not involved in this business on an ongoing basis and have committed to building infrastructure and relationships necessary with the refineries, with industrial companies that operate here, transport, store, buy, sell, not banks. You have to be in it. And so I just realized that there was nobody was providing the kind of service I wanted who was in it. And so I went into it. And so that's what I do. I mean, I don't know if it sounds a little opaque, but it's very straightforward. It's basically all the services and controls that you're used to in financial products, except there's nothing financial going on. It's just physical.
Okay, let's make sure that we completely understand that. So a little bit like a private fund where there's tens of thousands, and investors and alternatives like hedge funds should be very familiar with that. So I'm assuming likely it's a GP LP type structure. So they would effectively invest as what I'm going to say is an LP. If they're domestic in the US, I'm sure there's an onshore, but I'm sure you also have an offshore, perhaps Cayman Islands or somewhere else, which would be very common for what you're describing. That kind of structure is very interesting. It's unique, but I want to make very clear there is physical gold that is owned, but is that part of the fund, or is that almost a separately managed account that's kept outside a banking institution somewhere else?
No. It is outside the banking institution. What the fund, quote unquote, owns is an inventory of gold bars. And whenever somebody buys, they don't really buy into the fund until the fund buys gold with their money and puts the gold into the fund. So it's like you own a pro rata portion of the underlying inventory.
Okay, so it's outside of the banking institution, and it could be as commonly Switzerland and Singapore, two common destinations?
Yes. Well, and the reason for that is because that's where liquidity is. I mean, you want to be where there's infrastructure and liquidity to transact. Like during the COVID, we couldn't transact. Like if you wanted, some people store gold in Cayman Islands. Well, okay, they're still under quarantine even now. You can't get in or out or get stuff in or out. So in Switzerland and in Singapore, there's infrastructure where you can buy, sell, transport without having to cross borders and customs. That's important. And plus very, very friendly jurisdictions for these types of assets.
Why do it in this format if I'm the investor or interest in owning physical gold versus whatever, calling or working with a bullion company and having that delivered, even if it's outside of a banking institution, let's say similarly a Brinks or something like that? Why use your structure?
Well, I mean, everybody can do their own thing. I mean, you can make your own shoes, but if you have to run away from a bear, it's probably better that you have Nikes as opposed to the ones you made. I mean, it's it's like why use professional services or professional advices to anything? I mean, I urge everybody to go try to do it themselves. I mean, and then they'll know what the issues are, and then they'll appreciate perhaps why there's a need for somebody. I mean, that's how I got to it. I tried to do it myself, and I ended up on the street with a suitcase in a foreign country because situation changed and the service provider I had didn't want me anymore, and there I was. And so, because I was American, they didn't want me because I was American, and Americans are not welcomed, and that's it. And I had to find an alternative solution. So I realized that's not. I needed a Sherpa. You know what a Sherpa is? When
Yes,
you go
I
to
do.
the Himalayas, you can do it yourself. But if there's a snowstorm and the Sherpa knows, where to get provisions and what other trails may be available that are not closed, that's why you hire Sherpas. That's basically what I do. I'm a Sherpa in this gold world. Professional.
And it's an impossible question to answer, but I'm going to ask it because it's going to depend on the circumstance of the individual, what their goals are, longevity, diversity. There's so many different factors. But you said maybe among the world's wealthy, at least in the US, at most 99.9% are going to have upwards, meaning not necessarily there, likely less, but upwards of 1%, perhaps in some way. It might even be through an ETF or future. what would you recommend for physical gold for a family of wealth? Now, again, if they're worth billions of dollars, that's be very hard to do 10% of their net worth. What would you recommend? 2%, 3%, 5%, or more?
You know, that's not, let me turn the question. When you buy life insurance or property insurance, do you calculate that as a percentage of your portfolio? Or do you look at what potential losses could be and how much of that you can afford to self-insure and how much would you need to rebuild?
The latter, of course.
Okay, well, that's the answer to the question about allocation. It has nothing to do with percentage. If somebody's worth $1 billion, they don't need $100 million, even if they lose everything. I mean, what I mean by not needing $100 million, there's a certain amount of money that can ensure life with dignity, regardless of how much money a person would like to have. I mean, you know, so
right.
We can only eat 1 meal a day, or 3 meals a day, and we can only wear 1 pair of socks and 1 pair of pants at one time. And, you know, I mean, so I think that this allocation needs to be based on, if things really go badly, like what would I need to make it? Like, what if I have to make it on what I have left? Like, what would that be? It's not necessarily a huge amount of money. You know, I mean, it's depends on one's needs, but it's not, or desires, but it's not hundreds of millions usually. And so I approach it that way. And so maybe people with less money need to have a higher percentage, and people with more money need to have a lower percentage, because a lower percentage is still enough money to be fine, you know?
And what's the minimum investment in your private structure?
By the way, I'm not here to sell it. It's not the kind of thing that sells, you know, the one needs to sell. It's the kind of thing that people, you know, you don't go to a doctor unless you have a problem. You know, so I feel like I'm a little bit of a doctor. You know, people come to me when they think they have a problem, and they're coming, you know, to solve that problem. It's $100,000. So that's not.
Okay. I thought it was. I would have thought $1 million or more. So it's actually much less than I thought.
That's not an issue.
Very intriguing. I'm going to ask you a series, because we are a little bit time constrained, about 7 or 8 minutes left. A series of rapid fire questions. Here they go. Which central banks are the ones to watch in terms of buying gold? How much of it is being done secretly?
A lot being done secretly. The central banks that have been on the cutting frontier of buying gold consistently and in large quantity are Russian, Chinese. We don't know that, but, well, we know Turkish, but we don't know that, probably Iranians. And if you'd notice who these people are, you would notice that they are somewhat frenemies of the United States. And one of the main reasons they're buying this gold is because they want to get independence. They want to gain independence from the dollar and from the Western financial system, which the United States has declared jurisdiction over. So all these sanctions and all these you know, capital controls that are being imposed on different countries, essentially the United States leveraging financial systems. So they're doing what I think the wealthy should be doing, is they're buying independence. That's what they're doing. Independence is very not interesting unless you lose it. Then it's everything. It's like freedom.
What are the key price points for new mining technology? Specifically, is there potential for a lot more gold underwater?
No. I mean, there's a potential. Look, there's a company in Russia that just found the biggest find ever. And so what? They have no plans to develop it. They have no money to develop it. It's going to take 10, 15, 20 years before that is mined. You can't, the way I would answer it, there are certain processes in life and in nature that cannot be accelerated. We can assemble 9 pregnant women in a room, but we're not going to have a child in 1 month. No matter what happens, it takes 9 months on average. And it's the same thing with, it's exactly the same thing with gold mining. I mean, you can't just conjure up gold out from under the ground in a moment. Anybody who's been to a mine would understand. It's a major industrial endeavor.
if there is a gold price crash similar to what happened in 1981, wouldn't those holding physical gold be stereotypical as the last man standing, as they would be holding the most illiquid form of an investment, and they may be forced to sell in a deteriorating market?
If you own it's position sizing. Why would a wealthy family, it's a multi-generational asset. I mean, it's like saying the real estate price crashed and you own, family home is owned, I don't know, wherever. Family farm is owned outright. I mean, does that mean they have to dump it if it's not leveraged?
No, that would be the correct answer. Yeah, in terms of basically, you shouldn't have all your money in gold. So if something does happen where you need liquidity, like in any asset, you're not forced to sell at a discount.
Yeah.
I mean,
what you need to know is that it's not going to get impaired.
Yes.
There's volatility risk, but there's no impairment risk. So just like yeah, go ahead.
I'm not the first person to say this next quote. Yes, I took it from somewhere, but I think it's important and drives home what you've been talking about. An ounce of gold would have brought you a good suit in Renaissance Venice. And you know what? It will buy you a good suit today. Is this all we should expect from gold, just to hold pace with inflation and maintain purchasing power? And if so, is that such a bad thing?
A, it's not a bad thing in the era of negative real returns.
Right.
B, it's a positive return. B, the truth of what you're saying is correct over very long periods of time. There are periods of time, like during the 90s, for example, when gold does not keep pace because for various specific reasons, disinflation, financialization, people, went into financial assets. But there are times, like during World War II, there are times when the purchasing power of gold skyrockets fabulously. Price doesn't have to skyrocket, purchasing power. Because, I mean, think of it this way. Even if, like in 2008, gold went up from, I don't know, from 07 to 09, gold went up 25%. So you had $100, now you have $125. Stocks went down 60%. You had $100, now you have $40. So if somebody is buying distressed assets using their reserves, they're buying 3 times the value in stocks that they did just 18 months earlier. So that's the kind of thing I'm telling you. So if real estate in real terms declines and gold in real terms increases, you're buying a lot more than you otherwise would have. So yes, there are periods when purchasing power of gold dramatically outperforms. And that's what I expect would happen in this situation on a real purchasing power basis, because it doesn't have impairment, whereas a lot of assets that we think are assets are actually debt, and they are backed by debt, and they're levered to debt, and they would be impaired. Just like what we're seeing with some retail companies right now. I mean, some recoveries on the shopping centers, whatever, 2 cents on the dollar. I mean, this is what used to be real companies, but their claims that we're trading, their stocks are just, they're too subordinated to be worth anything. That's impairment.
I suppose this is my last question before we get to the close, and it probably would have been worthy of giving it more time. And I've been doing so much and a lot more to come on cryptocurrency and Bitcoin. You may cringe, Simon, but some say it's like a Swiss bank in your pocket. Some say it's liquid gold. Let's specifically stick to Bitcoin. And I know as a speculative investment, you're relatively, if you do your diligence and want to do so, it could be very intriguing. You're not necessarily on board that it's a store of value the way that gold is. If you could explain your reasoning, and again, I do have to cap it to about 2 or 3 minutes. Thank you.
A safe haven is something that is known to be safe and is proven to be safe through trial and error, scientific methods, hypotheses, and then testing, and then confirmation or rejection. Gold has gone through this test through thousands of years, through absolute plethora of situations, and has never failed. War, pestilence, whatever. It has never failed. This is new technology. We just don't know. It's never been through a real crisis. Nobody has ever tried to confiscate it. It is digitally dependent. It is not cyber independent asset. Gold is a cyber independent asset. It's cyber immune. And of course, if you are trying to be discreet, and if you're trying to use it as a safe haven, and potentially, given that government or sovereign risk may be one of the risks you're trying to solve for, what's such a good idea about having every transaction recorded on a ledger that can never be expunged? And the only thing that stands between you and the government knowing exactly what you did and how you did it and where you have it is the state-of-the-art cryptography, which is another technology that evolves continuously. So quantum computing comes in another 5-6 years. I mean, this Bitcoin is going to be obsolete. There's going to be Bitcoin 2.0. It's going to have to be something else. So for assets that are long-term, this has nothing to do with Bitcoin as a speculation or investment proposition or trading or anything. As a safe haven, we have no experience with it, that it's safe. And I would also say that whereas gold is owned by the central banks and is an asset that the governments may very well reach for to recapitalize their balance sheets, they don't own Bitcoin, and that would be an enemy of the state to the extent that they're trying to impose capital controls, and Bitcoin is a tool of evading them. And all the arguments that are made about Bitcoin being an easier transaction medium than gold are precisely the arguments for why that would be a much bigger threat to the governments than gold, because it appears to be easier to transfer money and to carry money. But the methods that the governments have to confront that are a lot deeper and more sophisticated than most people realize. And so, not to mention that all these transactions, one way or another, rely on the internet backbone. And then you can think of it as a highway. So yes, you have your car, you have your secrets in the trunk, but you got to travel on the government highways, and you got to pay tolls when you go through, and they record your tags every time you make a turn or take an exit. And so in that sense, those are the issues, and they have not been resolved.
No, I mean, you bring up some very fair points, Simon, and issues that we're covering when we talk about Bitcoin and crypto. I think that quantum computing, in terms of cracking the blockchain, may be not only just a long way off, but they're already working on potential solutions to help counteract that. And yes, although they don't know per se your identity, they do know the transactions on the blockchain. Zcash may be one answer around that. That's another form of cryptocurrency. And there are some advantages. We won't get into custody, cold storage, hard wallet in your head. And yes, in theory, you could travel with $1 gazillion of the keys to Bitcoin in your head. But if people know that and you get captured and tortured, you have a problem. So I am probably more than Simon, a believer in Bitcoin and cryptocurrency, but similar to probably my opinions on gold, which are very, very similar to Simon's in terms of as a hedge to the portfolio and almost a start over fund in an emergency. I think it should be, and I hate to put it in allocations, but Bitcoin should be a small allocation, but I don't think should be ignored, but I think absolutely should be actively managed. Simon, for those that would like to learn more about your organization, you also have an amazing website. What's your website URL and how could people reach out to you?
bullionreserve.com. Just bullionreserve.com, and you can reach through the website.
And if you don't, do you want to give your email?
There's one on the website, investors@bullionreserve.com. You could just email there and I'll see it.
Perfect. Everyone, I'm going to give a pinch of a longer close than I normally do because I really enjoyed this conversation. I think Simon's amazing. It was great to have him on. I look forward to having him on again sooner rather than later. I know this was near an hour and a half, and honestly, I took a look at my broad questions. I had 20 questions I couldn't even ask. We'll save that for maybe the first quarter in 2021. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles Podcast, and I'm the founder and CEO of Family Office Association. I help global families and their family offices solve problems, procure positive future outcomes, and prepare for intergenerational necessity. It's vital for families and their family offices to understand their vulnerabilities and become more resilient so they can mitigate risk and prevail during times of crisis. What do we do for our members? Our members get access to our content, our database of library of resources, access to me. And that includes, since I am an advocate of wealth preservation and the things that we spoke about today with Simon, my resources, my connectivity in the community, my opportunity to make connections to people like Simon, and potentially opportunity and pricing advantages that my members would receive. We do host global programming on hold because of COVID, but we do literally hundreds of online digital programs, deep dives similar to what we did today with Simon. We also consult on how to create or how to reinvent your family office. But again, the opportunity to preserve wealth, to have that moat around the castle. And there's so many complexities, onshore, offshore, foreign asset protection trust, Singapore, Switzerland, owning private banks, crypto banks, what's going on with LLCs, private trust companies in Wyoming, gold, Bitcoin. And that's just a small percentage. Why do I see significant families starting VC funds? Why do I see them creating GPLP interest? Why are they buying farmland? I could go on and on. Our members get access to all of this for the opportunity for them to make better decisions. What did I say earlier? To solve problems as well. You can reach me through social media. Go to Family Office on YouTube and subscribe. We put a lot of free content on there. My website is familyofficeassociation.com. And my direct email is angelo@familyofficeassociation.com. Thank you for watching or viewing today. Simon, you were an amazing guest. I look forward to the next time. Thank you.